picture in front of Powell looks like this. Janet Yellen is assuring backstops. The FDIC is doing their thing. Credit Suisse has been bought by UBS. The dominoes continue to fall in terms of risk aversion. And now, tomorrow at 2 p.m., Powell's got to present the decision on rates from the FOMC. And then we have the press conference, and that's where the fireworks are going to start. There's a lot of speculation as to whether or not Jerome Powell can actually pause. And the bottom line is, if he were to pause, we would see absolute panic, because the question is, oh my gosh, are things really that bad? So on the surface, it seems like, oh, great idea. Go ahead and pause rates. Some folks are even calling for cuts. What that would cause is a panic. We've been here before when the Federal Reserve has headwinds and they could be presented with a less hawkish alternative. But if they were to do it, the logical reaction then becomes, oh my gosh, what don't we know? All right, gang, I'm Raghee Horner. And for those of you that know me, I'm the lead trader over at Simpler Futures, as well as the Sector Secrets Mastery. And we're taking a look at the night before Powell. Not a creature was stirring. Yeah, not much. Let's take a look at the heart of the matter. Regional banks, right? Regional banks are tied very closely to the RTY futures contract. So if you're a futures trader and you're watching the RTY and wondering what the heck happened here, KRE is extremely important to the RTY, more disproportionately so than any other sector. If we take a look at the XLF, the financial sector, the big banks, if you will, that's very much a Dow futures and S&P futures conversation. Now, the S&P gets the added benefit of moving with tech, moving with the NASDAQ. Why does the NASDAQ get a reprieve? Because whether that be the XLK or the NASDAQ and QQQ there is less than 0.75%, not even a whole percentage point of financials weighting in the NASDAQ. So it can benefit from some risk appetite around the financial crisis that we're seeing. All right, with that being said, what is it that Powell can do? Well, that's not going to be found on the charts necessarily. We have to go ahead and take a look at the CME FedWatch tool, and I'll walk you through that. This is the CME FedWatch tool. If you've been watching me here for any length of time, you know this is a staple in macroeconomic analysis. In fact, we can argue that this is the only macro that matters. Let's take a look at tomorrow's meeting. As we wrap up the day, it's 18 minutes after 4 p.m. Eastern. We are at an 86% probability for a rate hike of 1/4 point. How do we know that? The current target rate is right here, 4.5 to 4 3/4. We're going to move up to 4 3/4 to 5%. So say the Fed Fund futures. That's a 1/4 point hike that is discounted. And anything above 80%, we can consider as fully discounted. All right. Now, the next question then becomes, what about May? There is a possibility. In fact, it's the leading expectation that we get another 1/4 point. So for those folks saying this Federal Reserve is less hawkish, they're less hawkish than they were on March 7, when expectations were actually up near 6%. They are not less hawkish in that they've shifted to an accommodative monetary policy. Not yet. Remember, gang, in order to fire the bazooka at problems, the printing press goes brrr, as we know. We need to hike rates to be able to do that, right? And that is where it gets very interesting come June. Come June, we're either going to go ahead and complete the move to 5 and 5.25%, which, by the way, gang, before all of this Humphrey Hawkins testimony, before the SVB debacle, this was generally where we expected rates to be, right around 5%. If you look back over the last 10 months in Fed Fund futures, the average started in the low to mid 3s, crept up to 4, and then we found a nice equilibrium in Q4, really late Q3, going into Q1 of this year, at about 5 to 5.25%. That is until March 7, where everything got ratcheted up to that 6%. So all we've done is walked back to where we were, sort of the most recent mean in terms of expectation. This is not crazy. This is pretty much where we were. This is not a conversation about what should they do, right? As they say, we can should all over ourselves. This is not about what should we do. This is what is being discounted. We are traders, you and I. We look at what's expected, what we did get, and the chasm between that is the market reaction, right? So what are we expecting? What did we get? And therein lies the volatility that we trade. Okay, so that's why we don't want to go into fantasy land of what should they do. Let the folks on TV yak on about that. You and I are trying to move our money in and out of the market based on data and based on sound methodology, a sequence, if you will, right? And the sequence starts here. What are we expecting? All right, now, if for whatever reason we get this, yes, the equity markets are likely going to sell off initially, but they should stabilize because, again, this is not a surprise. That means that if we get an initial move to the downside, what I'll recommend kind of harkens back to this video. This is a video still sitting at the Simpler Trading YouTube channel called 1 to 3 days. Okay, check it out. You can find it there. And what this is what is the time frame, 1 hour? What's the time horizon, 1 to 3 days, that I will continue to use as we're still making our way out of, the confusion, the concern, the fear, etc. Very nimble overnight positions on a 1 hour time frame, maybe a daily come Thursday once we get past the Swiss National Bank. Now remember, SNB we usually don't care about, but since we're seeing this whole Credit Suisse USB narrative, to what degree is the SNB committed to be the backstop to this whole plan? It's probably not going to matter as much as it might have, say, even a couple of days ago. But SMB is probably more so in play now because of Credit Suisse than it has in a long, long time. So we'll keep an eye on that. And then when we move forward from there, we can start to think about lengthening the overall time horizon. But the cool thing about the 1 hour charts, gang, is they can absorb the volatility. And yes, we are still in very volatile times. So they're going to better absorb the volatility and allow us to use the DPMRs in such a way that we can manage, measure, and trade the volatility with that 1 to 3 day time horizon. So that's really what I'm doing. And check that video out. It'll be a great supplement to our conversation here. In the meantime, gang, if you haven't already heard, I am taking over the newsletter that is called This Week in the Market. I'll be starting that this Friday. And you better believe Swiss National Bank, Powell, as well as what's happening with the financials, regional banks, the big four, that is going to be a big part of the conversation. What sectors do I have on my radar? What currencies? Which commodities? What's on the radar? I'm also going to talk to a handful, 1 to 2 of our traders here at Simpler. My hope is to talk to Bruce and John this week and ask them. All three of us have over 30 years experience in the market. We've seen different situations like this. What did we do then and what of it is applicable now? A lot of that's going to be in the newsletter. If you haven't checked it out, please do so. And I do want to let folks know that if you are a member of my Sector Secrets Mastery, it is included in the subscription. We're working on getting that to you. And everyone else, there is a $7 trial that you can check out if you're not currently a subscriber. All right, gang. That's it for me. Have a great one. Tomorrow's a big day. All eyes on Powell. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.